just now. Let's take the conversation forward. Sanjeev, normally we start with markets and Reliance, but I'm going to start with what really is the go-to space right now for markets, which is pharma. Fundamentally, what is your understanding of why pharma stocks are rallying, and are pharma stocks and pharma earnings on a clear upward trajectory?
See, the reason they rallied very strongly are, I guess, two things. One is the fact that going into COVID, they did look somewhat undervalued. Most of them were trading in the range of, 16 to 18 times March 22 EPS. Now we have seen a re-rating in most cases to, north of 20 times. So they're now trading at about 22 to 23 times. So what changed over here is, I guess, the reinforcement of the fact that, domestic business will continue to do well. And somewhere I think the market was probably underestimating the value in the domestic business, because these are businesses which will continue to grow at about, high single digit, low double digit for a fairly long period of time, and not very different from, the FMCG type of companies. And the second thing is, obviously these are complex companies which when we come to predicting revenues in the US, generic business and specialty business. But I think the market is getting more confidence on the numbers for at least for March 22 and March 23 now. Looking at the reasonably good performance from the company. There's also the news flow which has been positive, particularly for supply and Lupin. So all that is resulting in somewhat positive sentiment for the sector, which has resulted in the multiple re-rating. It's not as if the earning numbers have gone up a lot. Just in case of Cipla, we have increased earning numbers, but otherwise, minor increases only, which would not entirely explain the big run-up in prices, more to do with, I guess, better understanding of the dynamics of these companies by the market over the last 3-4 months.
Sanjeev, for the longest time, markets have been obsessed with what is happening to the US generic market. If prices go higher, Indian pharma stocks go higher. If prices go lower, stock prices, they go lower here. What is your understanding of the US generic market pricing? Because that still is like the mother market. I mean, what is BFSI for IT? I guess pharma is for US is for Indian pharma companies.
That's true, I guess, but only partly. As I was explaining earlier, these companies have a fairly good domestic business, particularly the likes of Cipla and Sun, which was probably not getting valued correctly. So US generic, remember you have a base business, which obviously over time, the profitability of that business gets eroded. But thankfully, companies have been, in a position to launch more products over the last, I would say 2-3 quarters. You have seen a bottoming of the revenues in the US, and at least the product pipeline looks reasonably strong until FY23. Even after that, depending on, whether some companies are successfully able to launch the projects, even up to 25, the product pipeline is actually looking pretty decent. Obviously, there's a lot of uncertainty beyond 23, so I don't want to get into all that currently. But at least you have a reasonable amount of visibility, I would say, on the numbers for FY22 and 23 currently.
Sanjeev, IT perhaps is the other pocket where you're seeing that conviction in the earnings in the previous quarter and conviction in the management commentary as well. Most of them managing to even stick their neck out and set out a guidance too. Having said that, the run-up as well has been pretty swift in the entire IT pack and across, market cap categories, both the large caps, the big boys, as well as even the mid and the small caps alike. Do you sense there is still opportunity for headroom within the IT universe? I beg your pardon?
Again, the stocks are run up, so in a way, the near-term upside will be somewhat limited. So it looks like, even in case of IT, it looks like March 22 numbers are getting discounted, which is pretty much the case for even the pharma news now. But what again has changed for the IT sector was in March, April, and even May, I guess the market's immediate concern was that there would be a decline in revenues in March 21, and then the recovery may take time, given the negative impact of COVID outbreak on the BFSI sector's revenues. But what the market has now understood, it looks like, is that there is a lot of pull forward of revenues happening elsewhere. In the sense, companies are being forced to invest a lot more aggressively in the digital offerings. So one thing which has happened as a result of COVID is clearly, every company which was going somewhat slow in its digital strategy has no option but now, to invest very aggressively over there. Whether it with respect to, customer acquisition, with respect to customer fulfillment, delivery, whatever it may be, companies are being forced, to really ramp up on the digital side. So I guess, that's where Indian companies are standing to benefit. And to some extent, people are also willing to now take a call that the earning numbers or the top line growth of these companies will continue to be on the higher side for a slightly longer period of time compared to whatever they had built in earlier. So that explains why the market is now comfortable giving somewhat higher multiples compared to what the stocks were trading at before the COVID outbreak.
The other theme which is playing out in the market, Sanjeev, has been the entire rural recovery. And we can see the data points indicate that it's the rural end of the economy which is recovering faster than the urban, be it the tractor sales, cases in point being in Escorts as well as the M&M tractor numbers. They've all been indicating a very buoyant recovery for the rural end of the economy. But what is the best way of, playing this rural recovery, Sanjeev, in your view? Is it through tractors? Is it via the agri theme? Or do you think stick to staples irrespective of the valuations that they're quoting at?
The names don't change. The usual suspect, agrichemicals, two-wheelers, more so motorcycles, tractors, usual FMCG companies. But keep in mind the fact that the recovery theme may have already played out to some extent. And it's a relative play ultimately between rural and urban. It's not as if the rural is doing meaningfully better, compared to the pre-COVID situation. It's just that it's doing better than urban. But do remember that there is a large part of rural India which is dependent on services sector, which will struggle. Also, the fact that you have now started to see, COVID outbreak in some of the more rural-oriented districts compared to earlier when only the urban districts were impacted by COVID. So that could also result in some impact on demand in rural India. So I would be a bit careful about extrapolating the trends which you saw in March, April, May over there. You had obviously a good Rabi crop, and you had bumper procurement by the government. And it looks like the Kharif crop will also be fine. But beyond that, I don't know what the story is really in rural India. Ultimately, you have to create jobs in urban India, which will result in migration of people from rural to urban, because the salary differential is massive between rural and urban, and ultimately urban India has to perform for rural to continue to grow on an absolute basis. One of the big drivers of urban India is also, remember, the repatriation of money which happens from urban India to rural India. Rural India by itself, cannot sustain beyond a certain point in time. And agriculture in its current form, and we have written a lot on this, is fundamentally not very viable. 12 million people dependent on agriculture, given the farm sizes, 1.1 hectares average farm size in India is simply not viable beyond a certain point. So if India has to grow, I think we have to move people out of agriculture to manufacturing and services. That's what the real story is, not so much in rural India continuing to do well.
Sanjeev, it would be great to get a little bit more from you on the kind of rationale behind financials currently. We've been looking at the range of valuations. You've talked about a little bit about the outlook as well going ahead. We know, of course, that there has been some amount of polarization within the financial basket as well. So talk to us really about how you see things evolving from here on.
It's a tricky one because you have a very wide range of valuations currently. You have some PSU banks which are at about below 0.5 times March 22 book. You have the better quality banks and NBFC north of 3 times. You have Bajaj Finance at 4.5 times March 22 to have extremely wide range of valuations. It looks like at this point in time, the market is taking a call based on historical underwriting abilities of banks and NBFCs, and disclosures of the banks and NBFCs on moratorium value, as also on the collection efficiency, which is a very simple assumption that low moratorium value is good and high collection efficiency is good. But that's a very simplistic way of looking at things. What also will matter is the loan books, the nature of lending, secured versus unsecured, etc., etc. So the current way we are looking at is, banking sector, given the huge amount of uncertainty with respect to the trajectory of COVID in India, and that is going to be critical. I don't think the current numbers, really matter. What will matter is how the economic recovery takes shape. If it is fine, then, probably every, bank and NBFC will get re-rated. And obviously the tier 2 and tier 3 banks and NBFC will get re-rated a lot more, given where they are trading. But if things continue to worsen in India with respect to COVID, which will also have a negative impact on the economy. And given the fact that banks are leveraged plays on economy, the credit costs and NPLs could be, much higher than what the market is building currently, assuming things deteriorate. And then in that case, tier 2, tier 3 banks and NBFCs will really struggle, but obviously the tier 1 banks, will also come off in terms of valuations. I mean, obviously they have gone up based on the recent positive news on decline in moratorium value and increase in collection efficiency, but I don't think that's really the end game over here. We'll have to wait and see how the situation pans out. I think it's only in the December or March quarter we'll have a better handle on the eventual level of NPLs and credit cost. And then only you can take a call, as to how we have got over this pandemic and how the books of the banks are holding in that case. So as of now, the only guides are, of course, historical underwriting abilities, the nature of loan book, and maybe valuations. So based on that, you take a call. How do you want to play this on a more top-down basis? Because the bottom-up numbers will become clear much later, I would say.
Okay, fair enough. Sanjeev, there have been certain changes that have been made to the portfolio as well. And, so are there certain pockets of the market that you would prefer to exit on the basis of feeling that they're going to be out of favor? Or is this purely just on, where you're seeing returns having topped out possibly? For example, I'm noticing a PVR, and I know you won't want to talk about specific names, but just trying to understand if there's anything that you'd like to stay away from currently.
See, the way we have played this whole COVID, situation over the last 4-5 months is, basically just divide the market in 3 buckets. The ones which would have not got that much impacted by lockdown, and second bucket was where demand got impacted significantly during lockdown, but things recovered reasonably fast. And the third bucket was where demand was impacted significantly during lockdown, but also, post-lockdown, you would see a very, very gradual recovery over there. So bucket 1 has done very well, which is essentially your consumer staples, IT, pharma, telecom, and including Reliance also over there, which were clearly not impacted much by the lockdown. And obviously, post-lockdown situation is fine. And bucket 2 was essentially some rural plays, and to some extent banking, financial services, where you see the reasonably quick recovery, at least in recoveries and so on and so forth. As far as the banks are concerned, rural demand has come back pretty fast. So those were the ways we played this whole lockdown story and this gradual economic recovery that we are looking at. Is it time to look at the tier 3 or rather the bucket 3 names, which are essentially your high-ticket consumer discretionary items or investment names? Too early looks like, because household incomes have got impacted. Corporate balance sheets have obviously worsened, and unfortunately, government's fiscal deficit number will cross 11% this year, and that is not because the government is giving stimulus, just because the revenues have collapsed to the government. And more importantly, public debt to GDP will reach somewhere about 85%. So the ability of any of these 3 segments to really spend goes down dramatically, whether it is households in terms of buying residential real estate, or private sector putting manufacturing capacity, or the government setting up infrastructure capacity, all that gets delayed. I remember going into COVID, this part of the market or the economy was anyway looking very fragile. You had 3 quarters of decline in gross fixed capital formation. And given the weaker financial position of all the 3 major players in the investment bucket, I guess, recovery will be a lot more delayed now. So unfortunately, it doesn't look like we'll have an investment cycle very soon. So you'll stay away from the names for the time being, unless until you have a 2-3 year outlook. Valuations are very supportive, clearly. Something like L&T, for example, valuations are fine. It has got a very strong order backlog, which can tide over the next 1 or 2 years. So that was fine. So if you find some names like that, companies which have very strong balance sheets and can tide over the likely downturn in business over the next 1 year or so, then that's fine. But other than that, it's a struggle really at this point in time, because the bucket 1 stocks are pretty fully valued. March 22 discounted, even March 23 getting discounted in some cases. Bucket 2 could go either way, especially the financial names, depending on how the COVID situation pans out. In bucket 3, you still have some time to go with respect, to a more structural recovery in demand over there.
Sanjeev, do you think this time around the recovery is not going to be broad-based? And the reason why I'm asking you this is because, unlike last recovery, where everything which was asset heavy, any company which was sitting on high debt, any company which had high operating leverage, they benefited. But this time around, do you think it's going to be a very niche and a very specific recovery?
I assume you are talking about 2008-9, which was the last time we saw a similar situation. Now, remember at that time, the consolidated fiscal deficit of India, that is between central and state, was 4.1%. Going into COVID, we were already at about 7% plus. And the government at that time, had the financial wherewithal to cut excise duty sharply. If I remember correctly, that went down from 14% at the start of the global financial crisis to 8% by April 2009. So that was a huge amount of fiscal stimulus which the government could provide at that time, which resulted in a pretty quick rebound in both the consumption as also investment demand. So obviously the lower excise duties, rates, etc., supported consumption demand. And the quick rebound in the economy did not result in the private sector holding back on investment. Remember, at that time, you had a very, very aggressive private sector willing to invest in all sorts of basic infrastructure. We have a very, very different situation, in fact, 180 degrees, different. We have a situation where the government is absolutely no position to provide any fiscal stimulus. So even if our fiscal deficit will go, north of 11% this year, it's not happening because the government is providing a stimulus. It is happening because the revenues will collapse, unfortunately, on the taxation side. And then you have, private sector, which is clearly not in a position to invest currently. Both the ability and willingness to invest problems are there. So I think if you settle down for a very, uneven economic recovery, and my bigger worry is, this very simple premise which everybody has when it comes to investment in India is that, no matter what, India will continue to grow at 6-7% GDP growth. I think that needs to be seriously relooked at because without investment, I think we'll struggle to get to 5% real GDP growth on a more, structural basis. Obviously, FY22, you will see a pretty sharp rebound in real GDP growth from the negative numbers in FY21. But beyond that, if you don't get investment engine to fire and don't create jobs, I don't know how you will see real GDP growth, getting back to a much higher level on a sustainable basis. And that's been the fundamental problem in this cycle. Things were slowing down, going into COVID. Government simply did not have the financial wherewithal to fight this slowdown. RBI is doing whatever it can do on the monetary side, but the ability and willingness to consume and invest both have been compromised pretty significantly.
Really appreciate your time. Thank you for joining us and stay safe.